In addition to management investment companies like mutual funds, unit investment trusts are another type of investment company. A unit investment trust, or UIT, will generally buy bonds or shares of other issuers for its portfolio of securities, and then issue redeemable units to investors, similar to a mutual fund. But unlike mutual funds, UITs are not actively managed by an investment advisor, nor do they have a board of directors. They are also not exchanged in the secondary market. Most UITs are fixed, meaning that they have a set date on which they will be terminated, at the maturity of a portfolio of bonds, for instance. Upon termination, when bonds have matured or other securities sold, the earnings are distributed to the investors. The objectives and other details of a unit investment trust are established and upheld by a trust indenture. A trust indenture is essentially a contract between a bond issuer and a trustee, typically a trust company or bank, who acts on behalf of bondholders to ensure that all established conditions are met. You can think of a trust indenture like the U.S. Constitution, which lays out rules for the country and rights for its citizens. Just as a trustee acts as a representative for bondholders, federal judges act as a representative force to ensure that the conditions of the Constitution are adhered to by those in power. Another type of security that aggregates investors' capital, similar to an investment company, is a real estate investment trust, or REIT. Many REITs are publicly traded on the major exchanges and can be bought on the OTC market, with portfolios often comprised of a diverse array of real estate investments, like mortgages or physical properties that generate revenue by collecting rent. As with other investments, REITs may pay dividends to their shareholders, which are taxable as income. Some REITs may also have special tax considerations. For instance, if a REIT meets certain criteria, it may be able to avoid taxation as a corporation. To do so, 75% or more of the REIT's investments must be in real estate. 75% or more of its total income must come from mortgage interest or rent, and at least 90% of its earnings from investments must be dispersed to investors. As with all securities, UITs and REITs are subject to risk, including liquidity risk, fluctuations of the market, and the risk that the securities or properties in which they invest may not perform as desired. To learn more about this and other investment topics, subscribe to the Zions Direct YouTube channel.